Good afternoon, everybody. Today is Friday, the 24th of June, 2011. Let's take a look at this market. I'm Brian Shannon, and we are on StockTwits. If you are viewing this on YouTube or anywhere else, I would encourage you to not only sign up for Twitter, but definitely for StockTwits, because that's who makes this whole thing possible. Anyways, the S&P 500 closed just above the 200-day moving average here. You can see the in the lower left-hand corner on that data table. We have the 200-day moving average right now at 126.51, and we closed 30 cents above that. So we've got the market still holding above the 200-day moving average, still holding above the March lows, but maybe we're going to get a flush below that one of these days in here. But it's still just a grind. This market was really pretty low volatility this week when you compare to not low volatility, but we're more range bound is what I meant. But we're range bound in here, really 126.5 up to 130. Let's take a look at the 10-minute time frame and just kind of frame that intraday from the beginning of the week. We had Tuesday was the day it looked like things were maybe gonna we had a possibility of having a week where we could make some headway into this market and that resistance at 130, but obviously the 130 proved too difficult to overcome. Market gave up a little bit on Wednesday, and Thursday we had that big gap down. Yesterday, more news, rumors about Greece, and so we had the Federal Reserve, we had Greece, we had a whole bunch of back and forth action in this market that really just turned out to be pretty much a whole bunch of nothing for the week. We began the week at 127.05, so I guess we're down about 30 cents in the SPY, but I think it felt like a longer week. It did to me, at least, with all this back and forth action. And it's too early to say that we're building support here and going to rally. It's just indecisive, and that's what we have to look at. Is we have an indecisive market action here, and until the market can prove itself a little bit better, there's always going to be some individual names that work well, but all positions really should still be maintained at smaller than normal sizes, and I'd say that for long and short here, just because we're at these important moving averages and support levels and that sort of thing. So smaller share size, and just have to have generally lower expectations. Cash is a position, and for a lot of people, the feeling is that you always have to be involved, always have to be doing something. Hey, my job is trader, so therefore I have to trade. Knowing when to be out is really one of the best traits that you can have, and realize that it's just not always going to be there. Anyways, the important levels for next week are going to continue to be really about 125.5 to 126 is where we would want to see this market find some support, and the obvious resistance, and is up at this 130 level, and that's where we have that 150-day moving average. So we've been this week and last week we're just chopping back and forth between the 150 and the 200-day moving average. What I was pointing to, I think on Wednesday, as maybe a possibility, was that we were going to see a right shoulder set up, and that would set up a move past 130, the neckline, and that resistance that we've seen, from back here as well, past that 130, maybe up towards the 50-day moving average. That's asking a lot, though. That's counter to the trend, and when we have a declining 50-day moving average, generally you're going to look at rally attempts as guilty till proven innocent. And in this case, we came up to almost perfectly intraday on Wednesday to that 20-day moving average. So if you think, well, if you're watching this, you probably don't think technical analysis is foolish, but look at how important these technical levels are, how 130 has been the key level, and that's where we found the 20-day moving average, how this prior support, this prior intraday support that we bounced from became resistance, and how we're finding some slowdown of this decline near the rising 200-day moving average. So we've got our key levels there in the SPY. For the Nasdaq, we closed below the 200-day moving average for the week, and we closed just down. I mean, for the week, we were only down 8 pennies in the Nasdaq. It sure felt a lot more volatile than that, though. Obviously, the closing number at the end of the week didn't it come anywhere close to telling us what was really happening in this market this week. And we can see that we've got quite a bit of volatility in here. The bigger level continues to be basically 55 and a half is what I would say is the 55 and a half to 55.90 maybe. That's the key barrier for the intermediate term. That if the market can get above that next week, well, then maybe. And again, you see here how this prior level is kind of in the same area, just like the S&P 500. But if we can get above this $55.60 area or so, then perhaps we get a squeeze rally up towards the declining 50-day moving average. But it's not, I don't think, going to be the beginning of a turnaround to this market. We've seen pretty deep damage in here, and we're at an area where we should be finding support, and it appears we are. So perhaps we get a bounce, but it doesn't seem like it would be something that could stick. And I think we take out the 54 level, then we're gonna go down and explore what the next area is, or at least test these lows once again. The Russell 2000, this market fared a little bit better for the week. We were we closed out last week at 78.23, so we were up about $1.70 in the IWM, and you can see, looking down, well, here on the daily time frame, it's been holding this key support level. This 77 level is the area we've been looking for as potential support. We've got that support being found. This market did bounce past the 79 level, and 79, when we look at the 30-minute time frame, this 79 level is very similar to what we see for basically 55 and a half for the Nasdaq and 130 for the SPY. So in other words, if this SPY was the Russell, it would have held this 130. So we can kind of frame it like that. It didn't hold it, very easily, because we got above it and then gapped down through it again, and we're still doing battle with that. But we are starting to see maybe a little bit more stability in the Russell 2000. It's not something to trust, though. We have a declining 50-day, 20 and 50-day moving average. There can be rallies, but they will typically fail, and you're playing a dangerous game, especially when you're holding them overnight. So, if you're going to be looking for upside action, I think you keep it to day trades only, and then there are some individual stocks out there that behave well, and we a couple that we were focused on looking at for subscribers today. Where this PCYC was a nice one, Caribou was a real nice pullback and then rally here today. CIGX, Krispy Kreme, soda is starting to look better again. You can see it's not quite there yet, but I think next week keep an eye on soda, and particularly near that 56 level. Getting back up through that area, then it could be back to the upside for SodaStream, and Under Armour had a good week and good day, and Lululemon, I think, closed at all-time highs, or I'm sorry, they did yesterday. But there are pockets of strength out there, but it's difficult to trust, and you have to trade smaller share size. The semiconductors, these guys continue to be pretty weak on a relative basis. They were up 13 cents on the week, and still having difficulty holding that 200-day moving average and fighting with the March lows as well. So this is supposed to be an important level of support for this market, and you would expect, or you would assign a higher probability because of the importance and the amount of time that it's spent finding support at this area, that you would assign a higher probability that it will in fact bounce, and it was kind of looking like that, but it still remains obviously a very choppy trade. We broke a little resistance, made this higher high, and then boom, just got kind of smacked back down in there again. So, 32 and a dime next week is going to be important. It's still just, we're trying to stabilize. It hasn't quite proven that it's leveled out. There are somewhat encouraging signs of stability, but, turning sideways and going and being neutral is not enough. It's just not bullish. The financials, we're just kind of turning sideways here, but within a downtrend. And yeah, there should be support down in here, but maybe it continues down towards this next level, down towards 1430 or so. It's very difficult to trust anything on the long side. The retail holders have been trying to bounce along that 200-day moving average. They made it all the way up to the 100-day this week, but still a tough road in here. This is again similar to the 55.50 level in the Nasdaq. So it's, and it's similar to 130 in the SPY. That is this level right here at about 106.80. So we're still fighting that, kind of similar, really more similar, I guess, to the Russell 2000. You can see how this Russell 2000 chart looks very similar to the retail stocks right in here. Of course, they're not perfect or anything, but that's the way they're starting to look. Anyways, this market just continues to be a very choppy, difficult environment to thrive in. So you look at it, and I pointed out on Twitter before. A lot of people, you don't see all the talk about silver. Silver, everyone was talking about it over in here, and then there's that old phrase: if they don't scare you out on the way down, they're going to wear you out. And I think it's kind of similar to. For instance, the uranium chart. You look at the uranium ETF after the tsunami and ensuing nuclear disaster in Japan. We had a big bounce, and then it kind of started turning sideways, and it's still resuming its downtrend. They're not safe to buy. It takes a while to heal the damage that's been done in all of these markets. These rallies are going to try to suck you in, and a lot of times they're going to spit you right back out. So if you're participating, best bet is on shorter time frames with smaller share size, lower expectations, and it's for most people. There's some people who do real well in this market, but that's not the majority. The majority of people in a market like this do encounter more difficulty, and if you can survive getting through it, then you're going to be ahead of not only most people, but you're going to have your equity intact for when the setups become a little bit easier and there's more follow through. So that's all I have to say for today. Thank you for joining me, and I will talk to you next week. Hope everybody has a good weekend.